Welcome everybody to Trader Karanja's channel. Today we're just going to cover something quite important to know for every single trader, and I hope that it adds value to your lives. So join me on TradingView. So the first thing I want to talk about is how to use Aussie yen as an indicator of risk sentiment. Okay, now what does that mean? That means that in the world globally, we're looking at whether we are risk on or risk off. So risk on just means that investors in the world are looking to onboard risk. They're happy to take a little bit of risk with their money. So that means that they're looking for riskier assets rather than the safe assets such as bonds and obviously safe haven currencies such as the Japanese yen, the Swiss franc, the US dollar. And what we look for when that decision is made by investors is money flow into the commodity currencies. Now, in terms of the commodity currencies, I know you guys are well aware of these, but if you're not, this is just a quick recap of what you may already know as a trader or what you're learning. Okay, so the commodity currencies can be termed as the ABCs, which means the Aussie, the British pound, the Canadian dollar. Let's just look at that for now. Let's just focus on that. Okay. Now, one of the things that you guys need to understand and remember is that each of these currencies will have a corresponding commodity. So for Australia, we're looking at gold exporting and also copper. Okay. The Canadian dollar, of course, we know the primary commodity is oil, being I think the third exporter of oil. And for the British pound, we're looking at their financial sector. Okay, so it's not really an export, but it is something that they consider as a commodity. Okay, so those are the commodity currencies. The safe haven currencies. Safe haven currencies, let's start with the biggest one, which would be the US dollar. That's the main one. Then we got the Japanese yen. Then we got the Swiss franc. I'm going to add bonds on here, because we are pretty much going to look at the relationship between bonds, the equity market, the commodity market, so we can be able to get the most high probability trades. Okay. Now, obviously, the US dollar is the reserve currency of the world. So whenever there's any global turmoil, that is where most people will move their money into. Okay. This is why the currencies increase as soon as we're in a risk-off environment. Okay. So how can we then use Aussie yen to kind of like understand what environment we're in straight away? The first thing that you need to understand is we're pulling out Aussie, which is a commodity currency, versus the yen, which is a safe haven currency. So let's look at how we can impose this. So the first thing we would do is click on TradingView. The beauty of TradingView is allowing you to be able to do this kind of comparisons so that you can be able to make a more informed decision. Now, I'll just go and compare, and I will type in Aussie yen. Okay, now that's my first filter. The first thing that you need to do as well is ensure that you pin it to scale and pin it to no scale, or pin it to the left of the scale, right? So easier to pin it to no scale. So if I scoot this box over here, okay, and I remember I'm just on a daily chart, so this market interrelationships happen throughout the whole day. I don't really use it myself for scalping. The lowest I'll ever go is on the 2-hour chart. I usually use it on the 4-hour and the daily. But for now, let's just stick to just understanding what it does first, and then you can backtest it on your own currencies. Yeah. Okay, so we're just going to look at the relationship right now. So we are looking at the Aussie yen. As the world moves into a risk-off environment, okay, as you can see, the world is moving down into a risk-off environment. Investors are moving their money into the dollar, and hence you can see price movements after, right? As soon as we bottom out and risk on environment comes into play, that means investors are happy to buy a bit of equities, a bit of they're moving their money out of bonds into equities, they're moving their money out of bonds into commodity currencies. We can see that the chart coincides with a movement in up, and the price obviously moves towards buying the commodity currency of the pound. Now, when we get to a place like this, whereby there's a dislocation between the risk on sentiment and price, we start to understand that this The Aussie yen is the first level of filtering before we look into other aspects of trading. This is not an indicator that tells you buy when it's going down or tells you sell when it's going up. This is a way to look at the global macro economics and understand what kind of environment we're in so that we can be able to find trades that are going to be in the favor of the global macroeconomic view. So that means the global sentiment, the global perspective. Where are we standing? Are we in an area where there's high inflation? Are we in an area where there's low inflation, low interest rates? Where are we? Okay. Once you understand that, then you can now start to look for currency plays or trades to take. Because the one thing that a lot of traders need to understand out there, the FX market is very complex. It's not guided by just one aspect, but has multiple aspects. So by looking at commodities, by looking at equities, by looking at bonds, and by looking at futures, we're pretty much putting ourselves in a position where we can look and trade only high probability setups. Okay? Instead of looking too deeply into the technicals, I'll be looking at the fundamentals because I want to trade in the direction of the fundamentals. Because fundamental news and fundamental information and economic news are the ones that actually create the trends. So therefore, I'm going to just use the technicals to complement my strategy and get the very best price that I can get. Okay. So around March 2022, right, there's a discrepancy here where we were in a risk on environment. Okay. But the cable was going down. And the reason for this is something very important took place here, and this is when the US interest rates started increasing due to the high and increasing inflation in the US economy. So what does that mean? That just means that as investors were getting higher interest rates for their money through the US dollar, they prefer to buy the US dollar rather than buy the commodity currency of the pound, hence they rally down. Okay, so this is all an increase in US interest rates. So this was a theme due to the Federal Reserve taking action to increase interest rates, therefore making the US dollar attractive for investors. If we look at any other currency pair, if we, for example, type in the Euro Yen, okay, you can see that the risk line or the Aussie Yen is highly correlated because it is telling you what kind of environment we've been in the last 1 to 2 years, okay? And that's an environment of risk on, whereby the world is happy to take risks in terms of investing in equities and in terms of investing in commodity currencies. So they're not looking at buying yen, rather they're looking at investing their money in a place where they can get higher yield and higher returns on their investment, right? So the Aussie yen is an indicator for any chart, CAD. If you just went to pound CAD, for example, pound CAD would represent two commodity currencies. The only way to implement any kind of trade on this would be for you to understand which currency is giving the investors a higher yield and higher return on their investment. Because money flow will always move to locations and to countries and to currencies or to assets that are giving the highest returns. Okay? So as you can see that we've been in a risk on environment, okay? Meaning that you can buy both the Canadian dollar and the pound, which means the market was ranging, okay? So the market was ranging. It is at this point where the market stopped ranging and started to decouple, meaning that we would have to look at the fundamentals that were driving this move downwards, okay? And the fundamentals that were driving this move downwards could be the high increase in oil. We know that oil correlates to the Canadian dollar. So higher prices in oil will reflect a higher Canadian dollar, which could be the theme that caused this to decouple from the ultimate sentiment in the world. So quite simply put, the move down towards strengthening the Canadian dollar, where people are buying the Canadian dollar or where the Canadian dollar is increasing in strength, could coincide with the oil price increases that we've seen in the last year in 2022. Therefore, telling us that we also need to look at the relationship between commodity currencies, right, and their commodities. We need to look at gold and how it correlates to the Australian dollar, when we need to look at the Canadian dollar and how it correlates to oil. Okay, there's other correlations that we might have to look at, but for now we just covered the most basic ones to help you understand how the Forex market is interconnected to other different markets. So join me in my next chapter where I cover how to trade bonds to trade the Forex market. See you then. Bye.